Hey, what's up, you guys? As always, every Thursday at 12, Avista Fund providing value to people. Today, we just want to say thank you very much. We closed officially on a deal in Dallas, 226 units, Eagle Creek Landing for all of our investors. Congratulations on that. Super exciting deal. It's going to be really fun to watch it going through the business plan stage, right? And repositioning from the previous tenants. Next stage for us will be, let's talk about the Vista Fund in general. What's the structure and what's the investment strategy, right, for this fund and why we actually came to an existence. And with that being said, I want to share my screen with the presentation. And today we want to talk with my journey. So we want to start with that journey, right? We want to lead with that. I was a former pro athlete. I was playing water polo back in Russia. So it's been quite a journey. That journey provided me a lot of travel, right? So it gave me opportunities to travel the world, to actually see how the people live, to expose myself to different cultures. And the experience of that was just something unbelievable. Yeah, I would love to do it again. But next stage came, and then I got some kids, right, in the family. I became a lawyer. I was like, how am I going to provide to the family? So it was the law school. I went to the law school, became lawyer, and the law was not something I want to do for the rest of my life. And we came to the United States and we opened the first business ever, right? It was Basketball Academy. It became very successful. And, we opened 1, 2, 3, 4, 5 locations. Meanwhile, I was investing in real estate. So I became an investor, right? By a mindset, I would say, most important, because investor is a different mindset from entrepreneur, sorry, to the employee, which is the lawyer. I was employed by the court system. And the great journey of that entrepreneurship will give you the idea of how to make money, right? But the second idea, how do you actually save money and how to grow your wealth? And this is exactly my development, my internal, I would say, personal development was in from the entrepreneurship, right? And making money and the business side and really understanding how the cash flow works and how the capital accounts work. We start to say, okay, where do you actually put the money at work? Where do you employ your capital so you don't work 24/7? Because entrepreneurship is really, really burdensome journey, I would say. But at the same time, it's very rewarding. But next as she said, okay, listen, I don't have an energy, right, to do it until the end of my days. And then as I age out, right, I need to phase out from the like very, very active business into the business still, but you're not like physically involved, right? You're more like involved with your decision making, right, and controlling the assets, but not actually physically doing the work. And that's how I became a fund manager. Why? Because you start to see different asset classes, you start to understand the market, and I tap into alternative investments. As you guys know, there is a general market, general investments, and then there's alternative market. And the market of alternative investment could be very, very overwhelming, and nobody knows where to go until you really start to understand different asset classes, different locations, different management companies, different investment types. And being a fund manager, right, I said, listen, I want to provide that opportunity to the retail people, to the people who does not know what's an alternative investments, for the people who actually accredited investors but do not even know they are accredited investors. And it's all very, very confusing, right? The whole ocean of those opportunities and investments are very, very confusing until you actually dive into that. And then what I did in 2020, I dove into that, and my focus was real estate. And from there, we opened the Avista Fund. That's how the Avista Fund came to existence, because I was investing in real estate, and we've been sold online. Like, we clearly been sold online. The real estate is a passive investment. But if you ask the owners, if you actually ask the multi-unit owners, or maybe like a single family houses who has like 3, 4, 5, 6, 7 houses, ask them about the pains, ask them about the management piece of it, especially in California. It's not easy to be the property owner in California. That's one. It's not easy to manage through that. It's not easy to pay liabilities every single month and actually make money. The only way out is the market, right? If you sit in the boat of real estate, the way out for you, and you leverage, by the way, right? So you leverage at 20, 30, 70, like, I don't know, whatever the percentage, probably 70, 80%. The only way out, if the water comes in, right, and the tides lift you up, and then you actually betting on appreciation of the market. No, for me, playing that game is a little too risky. And I said, listen, I understand it's not passive now, and I want to find something passive. That's one. I understand it's not just the cash flow, because there's no cash flow in California if you're buying it, the property, right, with leverage, and you buying at the high valuation at the high price. So I want to be part of the game when the investment's truly passive, number one. And then secondly, when investment is actually valued by the amount of cash coming in, by the net operating, by the income coming in every single month, every single year. And that game were more familiar for me, for myself. And the reason why, that's how you value every business. Or yes, there's a future opportunity, but you want to capture today market, today price. And this is the importance of really understand what type of game you're playing. So are you playing actually the game which is based on X factor of the future, which is the, again, valuation of the market, which is the stock market, which is, again, the real estate market, or are you playing a more controlled game? And again, multifamily, like I said, that's the game for me, because it's based with the valuation of multifamily based on people paying you monthly and net operating income coming in monthly and coming in yearly right into your project. Okay, so next slide. Once you own one, two pieces, it's probably fun. It's still fun. You're on the stage. I can do that. It's working. So there's cash coming in. There's like minimum cash flow. Again, if you leverage, if you bought it cash outright, that's a different story. But again, so you're earning like very minimal on your money. And the second story is you like, okay. And my question was to myself, how much of the real effort I spend a day on my real estate portfolio? How much actually brain power, how much of the physical power I spend daily on my portfolio, right? And again, when it's 1 and 2 units, it's still fun. Get into the 3, 4, 5, that's might be burdensome, right? The maintenance burden is unreal in California, because people, I'm talking about the tenants, entitled to everything, meaning, so they expect a landlord, when I'm saying entitled, so I'm going to explain that. So when they expect landlord to take care of mostly like every single thing in the property, right? Not to say that only, you know, the huge piece of it, it's a government, like the government, what the local government is doing, what are the actually laws, right, supporting the landlord, and then all the local government actually support the tenants as well, right? This is our California state. So when you own a piece of property and you come in and you kind of complain and do something, they say, okay, you the owner, you're responsible for almost everything, right, in the life of the tenant, which is kind of tough, and it's a burdensome as well. Why? Because all the expenses lays on your shoulders. With that being said, throughout that journey, we found a multi-family investing. Again, I'm going to explain once again, very important. If you buy a single family house, you put the tenant in place, you do some, like, let's say remodeling, right? You really betting on this appreciation play, right? Because they're on the cash flow, there's nothing coming in monthly, right, into your account. Like you got $200, $300, $400, $500, let's say, monthly coming in. But then think about when the tenant drops, right? When the tenant like saying, "Oh, sorry, bye bye, I'm going to go to a different place." Now you got 2 months of searching for a new tenant. What does that mean? So you're losing the money. Meanwhile, you're paying the liability because you're still paying your mortgage. Right? There's no way you can recapture that loss within the next year or two, right? It's going to take you a while to recapture that. The only way out of single family ownership is the market appreciation. You gotta be, and we got lucky in 2020 because every like house boomed, like almost double in value. But what's going to be next? All right, do you think it's going to double next couple of years as well? So it's going to double every 4 years? Probably no. And the question is here again. So why would you go into multifamily? Because if you got a 100 units, right? Let's say you got 50 units, right, in the property, and then 48 people paying rent and then two of them are not, that's still fine, right? You can still capture all the profit, you can still distribute money to the people, so there's still enough cushion for you to actually run operations, right? And then a lot of times you can go down as low as like 85%, right, in occupancy rate, and you're still fine. But again, it's your thing to do. So what I'm saying is here, so you're not going to get affected by a couple of people leaving your property. That's one. And then the second thing, if you are like succeeding in certain business, for example, you're like a really, really good doctor. We got Justin here, right? He's a really good doctor. Um, that means again, so you are 100% focused on something which is making you money, and you're probably one of the best because you 100% focus on one thing. So because of that happening, you want to make sure you're not buying yourself another full-time job, because owning single family units at the scale at 10 plus, it's a full-time job unless you have enough cash flow to delegate to property management company. But again, if you're just a small portfolio, a property management company will eat you alive. Why? Because they charge you a lot of fees. That's one. Because you're going to be probably something between 5%, 8%, right, per month, or whatever the yearly. And they're going to play that game of, oh, you need to change this, or you need to change that, right? Or you need to change the heater, the boiler, this. So that's how they make money as well, right? So what I'm saying here back there, if you got your job, if you focus 100% of the time on your job, right, then you actually succeed and you're making good money. So there's no other way unless you're going to be a limited partner and you actually doing the truly, truly passive investing. It's still not passive because you need to check the reports. You got to be proactively reaching out to us, for example, right? This is a great operator, right, of the property. And then at the end of the day, so like I said, but it's truly passive thing. You're not doing with your hands the operations. And in my opinion, the syndication, the private equity investments, this is the only thing which is not attached to the stock market. Because when the stock market is crashing down in 2-3 days, right? You're looking at your real estate, you say, oh, it's not crushing, right? People are still living there. People are still paying the rent. Why would it crush in value? It might be, right, adjusted, but it's not going to crush anywhere because it's a hardcore asset, right? Okay, so what I'm saying was that journey, and throughout that journey of owning single units, we found out there's one thing: there's got to be scale, right, of this model, which is multifamily. And then the second thing, there's got to be a truly passive way to earn income, right? And this is the syndication model as well. Okay, with that idea, the number one rule always for us was never lose the money. And then it's came from, for you guys who came from, right, it's Warren Buffett. And then I always love number two as well. Rule number two, never forget rule number one. And as you guys know, all right, the safest investment, what do you guys think the safest investment? It's a high yield saving account. And again, it's certificates of deposit, or maybe the bonds, corporate bonds, the government bonds. And the problem with those, you do need to pay taxes on that still, right? You need to probably overcome the inflation issue, and it's liquid, because sometimes if you're not sophisticated enough, you start to panic. What I'm saying, it's disadvantage here in this model, right? If you're not sophisticated enough, and if you're scared, if you're not controlling your emotions, you can just go down, right? You're going to be in red, and you click that button, you sold it. So in real estate, it's not possible. Now, there's certain process to go through. There's certain business plan to go through. For the people who's not able to control attached emotions to the money, when you're losing, when you see red, you want to like get rid of this pain right away, which is you selling at loss. So for those people, it's actually a really, really good investment because it's illiquid. illiquid. It's not liquid, it's illiquid. You cannot sell it as you panic, right? Problem with the stock market, when you see Apple stock down by 50%, you're like, oh, I'm going to sell, I'm going to get out, right? You just sold it, right? The next week or day or month or 6 months, it's going to come back to the same price and it just keeps going up, right? So in this investment, you guys very solid because you trust to the, you trust your money to the team, right? And the team saying, so listen, it's not the time to sell. Number one, you cannot sell it, right? It's got to be like 3 to 5 years before we complete the full cycle of the business plan, and then you can sell it. Okay. So, and lastly, I want to go over, right, the pyramid and then Avista strategic risk pyramid. When we open the fund, we target the people who has cash, retirement accounts, stocks, bonds, rental properties, and they've got enough, right? When they can start to pick out from that base layer. It's very important to have that base layer covered, meaning you do have enough cash to leave for next year. So you do have enough on the retirement account, right, for your retirement. You do have stocks, right, which is you can play with, right, for the growth. And then you got a couple rental properties, but you start to peak out saying, listen, it's not enough for me to earn 5, 4%, 3%. I want to take a little bit more risk to get a better return. That's where you tap in. That's where we found the best opportunities in alternative markets, meaning the private placements, meaning the private opportunities. It's not accessible for public. Those are unique opportunities, right? Those are open and close really fast. And the reason why, because there's a lot of people with money, and there's a lot of people who's kind of striving to earn more than just the 4 or 5%, right? Safety. So, and then you just allocate as you look at the pyramid, right? The more you go to the top, right, the less money you allocate to those risky things, right? You want to keep the majority of the money as a very, very safe investments. And then you pick out to the next level, right, which is going to be the alternatives, but maybe on a debt side. So when you actually providing the capital to the other people who is doing the multifamily or maybe commercial real estate, and then the form of loan, you do have a paperwork, you do have a basically guarantee of them paying you back money. It's not like investment. It's actually the form of loan. So those are the debt credit card, like this is the credit fund, which is on a debt investment side, meaning so you provide the loan for people and they will pay you back monthly, right, or quarterly. Those are very, very considered very safe investments, but it's a still double-digit return, which is great, right? The second one is when you go up to the pyramid, right, it's a little bit more risky. So you probably targeting between 8 to 10% here on the private credit fund, and then you picking out, right, a little bit more, and then now the target between 14 18%. It's like a high double digits. It's already something, so you don't get the cash flow as much, but you betting on the future a little bit more on the business plan completion. So those are, again, a little bit more risky, but you get in about 14, 15, 16, 17. Those are like juicy risk adjusted returns. It's still in real estate. It's still safe. It's a little bit more risky because it's based on the completion of the business plan. Whether it's going to complete or not, it's based on the team. So, and you want to make sure you know where you're placing your money here. And then lastly, what we do, so we just created that top pick of the pyramid when you really focus on something unique. So in our case, it's organic food. We got some organic food deals coming through, and our two top ones was the salty and coconut cold. The company grew like 2 times within 2 years, like from 20 million revenue and 46 million revenue. This is a big difference. Those are the placements. Again, it's not for everybody. So we'll probably allocate the minimal amount for those type of investments, but those are very juicy. It could be like 5x, right? Could be like 10x, depending on the deal. Could be 0 as well sometimes. So those are organic foods, and then land entitlements. Again, a little bit more risky, but it's still heavy on the return side. Okay, so I'm gonna stop here, right? You guys, if you want to learn more about the syndication, about what we do, about the fund, and about the existing opportunities actually today, go ahead and scan the barcode. right, and download that book. You want to start with multifamily 100%. You want to start with real estate. You want to start with something tangible, with something you can touch and understand easily, right, before you tap into some like higher risk returns. And that's going to be the great start for you, because it's going to talk about syndication. And the website is winrealestategame.com. Again, it's Avista Fund. It's an ebook. We create that ebook for the people who wants to start. They got 3, 4, 5 real estate single units, the properties, and they want to start with syndication model. So it's a winrealestategame.com. Scan the barcode, right? Go download the book. Let us know if you got any questions. You can always shoot us email, invest@avistafund.com. And we'll see you guys tomorrow. Tomorrow we're going to host really cool event. It's going to be in LA, so it's in person. We start at 5:30. Let us know if you're a accredited investor, if you're high net worth individuals, you want to be part of it, send us email, and we'll get you going there. Okay, you guys, peace out. Thank you very much, and I'll talk to you soon. Bye-bye.